Investing is most intelligent when it is most businesslike. These timeless words by Benjamin Graham, the father of value investing, are more relevant today than ever. Welcome to this summary of The Intelligent Investor, one of the most influential books in finance, a guide that has shaped the investing philosophies of legends like Warren Buffett, who famously called this book, by far the best book on investing ever written. In a world filled with flashy stock market tips, crypto hype, and overnight millionaire promises, Graham's wisdom provides a steady, rational approach to building wealth, not through speculation, but through disciplined, long-term investing. Whether you're in New York, London, or Berlin, whether you're saving for retirement, building a college fund, or just looking to grow your wealth, the principles in this book apply to you. Over the next 15 minutes, we'll break down the core lessons of the intelligent investor, including the difference between investing and speculation, how to protect yourself from costly mistakes, the concept of Mr. Market, and the importance of a margin of safety. By the end, you'll have a clear framework to approach the market intelligently, avoiding emotional pitfalls and focusing on sustainable wealth creation. Benjamin Graham begins by distinguishing two types of people in the market. The defensive investor, who prioritizes safety and stability. The enterprising investor, who seeks above-average returns by putting in extra effort and research. For most individuals, busy professionals, parents, or anyone without the time to analyze stocks daily, Graham strongly recommends being a defensive investor. Think of this like your retirement 401k or European pension fund. The goal isn't to beat Wall Street traders but to grow your wealth steadily over decades. The essence of intelligent investing is this. An investor is someone who carefully analyzes a company and its value before buying. A speculator, on the other hand, bets on the stock price going up, often based on hype or rumors. This is as true today with meme stocks and crypto pumps as it was in the 1940s with railroad and oil companies. For example, imagine you hear about a new AI startup skyrocketing in price. A speculator jumps in because everyone else is buying. An intelligent investor steps back, studies the company's financials, its long-term potential, and whether the price makes sense before acting, or simply avoids it altogether. Graham's golden rule is capital preservation. The essence of investment management is the management of risks, not the management of returns. This means your primary job isn't chasing massive gains but protecting your hard-earned money. Over time, steady compounding will create wealth far more reliably than gambling on trends. One of Graham's most famous metaphors is Mr. Market, a fictional character representing the stock market's mood swings. Imagine you own a small business. Every day, your business partner, Mr. Market, comes to you and says, "Hey, I want to buy your share of the business." Or, "I want to sell you my share." Some days, Mr. Market is wildly optimistic, offering to sell you shares at an inflated, ridiculous price. Other days, he's depressed and fearful, willing to sell at bargain prices. Your job as an intelligent investor? Ignore Mr. Market's emotions. You don't have to act every day. You only buy when he's offering you a good deal and sell when prices are way too high. This lesson is incredibly relevant today. Think about the COVID-19 market crash in 2020. Panic drove prices down to historic lows. Those who understood Graham's teachings saw it as an opportunity to buy quality stocks cheaply. Those who panicked and sold at the bottom locked in permanent losses. Similarly, during the meme stock craze with GameStop or AMC, prices skyrocketed far beyond intrinsic value. Graham would advise staying calm and not chasing the herd, because these situations rarely end well for average investors. By thinking of the market as a moody business partner, you detach yourself emotionally and make rational, disciplined decisions, the hallmark of an intelligent investor. The margin of safety is Graham's most powerful concept. When you buy a house, you don't pay full price if the roof is leaking and the foundation needs repairs. You demand a discount to protect yourself from unexpected costs. Similarly, when buying stocks, you should only purchase them when they're priced well below their actual worth. This way, even if your analysis is slightly wrong or the economy dips, you still have a cushion protecting your investment. For example, a company's intrinsic value might be $100 per share. But you only buy it at $70 or lower. That $30 difference is your margin of safety. Why is this so important? Because no one, not even Warren Buffett, can predict the market perfectly. The margin of safety acknowledges human error and market uncertainty. This principle is critical for retirement investing in the US or Europe. When markets crash, as they did in 2008's financial crisis or during the dot-com bubble burst, those who bought with a margin of safety were protected, while others faced devastating losses. As Graham says, the purpose of the margin of safety is to render the forecast unnecessary. It's not about predicting the future. It's about building a protective buffer so that whatever happens, your wealth remains secure. Graham outlines two main paths. 1. The defensive investor. This is for people who have limited time or knowledge about the stock market, prefer safety over high returns, want a set it and forget it approach. Portfolio recommendation: 50% stocks, 50% bonds. Rebalance annually to maintain this ratio. Focus only on high-quality, blue-chip companies or low-cost index funds like the S&P 500 ETF, e.g., Vanguard or iShares. For a modern U.S. example, your portfolio might include a Vanguard Total Stock Market Index fund and a U.S. Treasury bond ETF. If stocks grow to 60% of your portfolio, you sell a bit and rebalance back to 50-50. This simple strategy has consistently outperformed most active traders over decades, proving that patience beats prediction. 2. The enterprising investor. This path requires time, skill, and discipline. Here's what it involves. Deep analysis of companies, reading balance sheets and income statements. Buying undervalued stocks others overlook. Avoiding hype-driven trends and sticking to fundamental value. Example. During the 2020 pandemic, some travel companies were severely undervalued due to fear. An enterprising investor who carefully analyzed which companies had strong balance sheets and would survive could buy in cheap and profit massively when the market recovered. But Graham warns. For most people, attempting to beat the market is a fool's game. Unless you truly enjoy research and are willing to treat investing like a part-time job, stick to the defensive approach. Benjamin Graham was very clear about the dangers of speculation. Speculation is when people treat the stock market like a casino, betting on short-term price swings instead of focusing on a company's real value. Modern examples of speculation include meme stocks like GameStop and AMC, where people buy because of hype, not fundamentals. Cryptocurrency pumps, where coins skyrocket in value based on social media buzz and then crash just as fast. Day trading apps that make it feel like a video game rather than a serious financial decision. Speculation isn't always bad if done in small amounts, like buying a lottery ticket for fun. Graham allows a play money account, but he says this should never be more than 10% of your total portfolio. The other 90% must be managed with discipline and long-term thinking. Common investor mistakes. Chasing trends, buying whatever is hot right now instead of sticking to your plan. Overconfidence, believing you can outsmart the market without proper research. Neglecting diversification, putting all your money in one stock or sector. Panic selling, selling at the bottom during a crash because of fear. Ignoring costs, paying high fees for actively managed funds when low-cost index funds perform better. Graham emphasizes that avoiding these mistakes is often more important than trying to pick winners. Consistent discipline beats occasional brilliance in the long run. The investor's chief problem, and even his worst enemy, is likely to be himself. This quote reminds us that emotions, not the market, are the real challenge. Inflation is the silent enemy of wealth. Even if your money is sitting safely in a bank account, over time, its purchasing power decreases. For instance, in 1990, a gallon of milk in the U.S. cost $2.78. In 2024, it costs around $4.50 or more. That's inflation at work. If your investments don't grow faster than inflation, you're actually losing money in real terms. Graham suggests several ways to protect against inflation. Stocks. Stocks represent ownership in real businesses, which tend to grow revenues and profits with inflation. For example, companies like Apple or Coca-Cola can raise prices over time, preserving value. Bonds with inflation protection. In the U.S., these are called TIPS, Treasury Inflation-Protected Securities. They adjust with inflation, keeping your purchasing power stable. Diversification across assets. Include some international investments or commodities like gold to hedge against currency devaluation. For Europeans, this is especially relevant during periods of currency volatility or economic uncertainty, like the Eurozone crisis or Brexit-related fluctuations. The key takeaway is that cash alone is not safe. To truly preserve wealth, your investments must outpace inflation consistently over time. By now, you might be wondering, okay, but what does this look like in practice? Here's a simple Graham-inspired portfolio that works for most people. Step 1, 50/50th split between stocks and bonds. Stocks. Use a low-cost index fund like the Vanguard S&P 500 ETF, VOO, or iShares Core S&P 500 ETF, IVV. This gives you exposure to the 500 largest U.S. companies, automatically diversified. Bonds. Choose safe government bonds or bond ETFs like Vanguard Total Bond Market ETF, BND. Why this works? When stocks crash, bonds usually rise or stay stable, providing balance. When stocks rise, you benefit from growth while keeping a safety net. Step 2, rebalance annually. Once a year, check your portfolio. If stocks have grown to 60% and bonds drop to 40%, sell a bit of stocks and buy bonds to return to 50/50ths. This forces you to buy low and sell high automatically. Step 3, add small, play money if you want to speculate. If you enjoy picking individual stocks or crypto, limit this to 10% or less of your portfolio. Treat it like entertainment, not a serious investment. This strategy might seem boring compared to flashy day trading or chasing the next Tesla or Bitcoin. But boring is beautiful in investing because it's consistent and sustainable. As Graham famously said, to achieve satisfactory investment results is easier than most people realize. To achieve superior results is harder than it looks. Though The Intelligent Investor was first published in 1949, its lessons are more relevant than ever in today's digital age. Consider the recent cryptocurrency boom and bust cycles. People were caught up in speculation, ignoring intrinsic value. Many who invested without a margin of safety lost fortunes. Or think about the global financial crisis of 2008. Those who panicked and sold at the bottom locked in losses. Those who stayed disciplined, following Graham's defensive strategy, recovered and grew their wealth over the next decade. Graham's teachings remind us that markets will always fluctuate, don't get swept up in emotions. Diversification and discipline beat risky bets. Focus on long-term wealth, not short-term excitement. Whether you're an American saving for retirement, a European investor navigating currency risks, or anyone seeking financial freedom, these principles transcend borders and time periods. Benjamin Graham's The Intelligent Investor is more than just a book, it's a guide to lifelong financial stability. Here's what to remember. Distinguish between investing and speculation. Treat the market like Mr. Market, ignoring emotional swings. Always demand a margin of safety. Choose whether you're a defensive or enterprising investor, and stick to your plan. Protect your wealth against inflation through smart asset allocation. Avoid common mistakes like chasing trends or panic selling. The most important lesson? The investor's chief problem is likely to be himself. Your own emotions are the greatest threat to your financial success. By staying calm, rational, and disciplined, you can build wealth steadily over time. If you enjoyed this summary, consider reading the full book for deeper insights. And remember, intelligent investing is not about luck or timing, it's about patience and principles. Thank you for listening, and if this audiobook summary helped you, don't forget to follow for more finance summaries on YouTube and Spotify. Your journey to becoming an intelligent investor starts today.